All right, let's get right into it. Should I put some money into crypto? I bet you've asked yourself that question. It is, without a doubt, one of the biggest questions for investors today. You see the crazy headlines, you hear the wild stories, and it feels like this massive, high-stakes decision you just can't afford to get wrong. So in this explainer, we're going to cut through all that noise and build a real professional framework so you can make a smart, educated decision that's right for you.
So here's our game plan for today. We're going to start with what I call the crypto dilemma, that feeling of being pulled between massive hype and paralyzing fear. Then I'm going to give you a super powerful 4-pillar framework for investing. After that, we'll actually apply it directly to crypto, cover the absolute golden rule of risk management, and finally, we'll wrap it all up by building a personal investment blueprint so you know exactly where, or even if, crypto fits into your financial life.
Okay, so let's kick things off with this crypto dilemma. It's a real emotional roller coaster, isn't it? On one side, you've got FOMO, the fear of missing out. You see these stories about people becoming millionaires seemingly overnight, and you think, man, I gotta get a piece of that. But then, on the other side, you see the insane volatility, the stories of people losing everything, and that creates this deep, gnawing fear. It's this exact tug of war that either paralyzes people into doing nothing or causes them to make really rash decisions.
And this really boils down to one central question. Are we investing here, or are we just gambling? Let's be honest, a lot of the crypto frenzy is fueled by the hope of a lottery ticket-style payoff. But hope is not an investment strategy. Real investing, that requires a process, a system, not just crossing your fingers and hoping for the best. And today, we are going to build that process.
You know, there's this old saying that is just so true. The financial markets are the place in the universe with the most involvement with the least knowledge. And wow, is that ever true for crypto? This massive knowledge gap is a huge, huge risk. When you put your money into something without really understanding what it is or how it gets its value, you're not really investing, you're just speculating. Our whole goal here is to shrink that gap for you, because not knowing the rules doesn't get you off the hook. It just makes you more likely to lose.
So this right here, this is our mantra for today. We invest based on criteria, not gut feeling. This is the foundation for everything we're about to do. We are going to systematically remove emotion, hype, and gut feelings from the equation and replace them with a disciplined system. This is exactly how professionals approach the market, and it's how we're going to approach crypto. Okay, so to make decisions based on criteria, we need a system, right? So I'm going to introduce you to a timeless framework I call the 4 pillars of investing. And the best part about this framework is that it's universal. It works for stocks, for real estate, and yep, it even works for something as wild as crypto. Think of this as your new toolkit for making smart financial decisions. And here they are, the 4 pillars. First up, fundamental analysis. What is the actual underlying strength of the thing you're buying? Second, technical analysis. What's the market thinking? Are people bullish or bearish? Pillar 3 is all about cash flow. Does this thing actually pay you to own it? And finally, the big one, risk management. How do you protect your butt when things go wrong? You need all 4.
All right, enough theory. Let's get our hands dirty. This is where we take the first 3 pillars of our new framework, and we're going to run cryptocurrency straight through them. And look, we're not looking for a simple thumbs up or thumbs down here. The goal is to do a clear-eyed, objective analysis to see how crypto really stacks up against our criteria. Let's start with pillar 1, fundamental analysis. Now, if you're looking at a company like Apple, you can dig into their earnings reports, their profit margins. There's a ton of data. With crypto, it's a completely different ballgame. The fundamentals are really all about the technology itself. Is there a real-world use case for this thing beyond just speculation? What problem is it actually solving? And this is a big one. Does it have staying power? Or could some newer, better technology come along next year and make this one totally obsolete? Next up, pillar 2, technical analysis. This is all about the strength of the market, which for crypto is often just a study in mass psychology. The prices are massively driven by news cycles, social media hype, and a powerful herd mentality. And it's absolutely crucial to understand that crypto usually acts like a risk-on asset. What that means is when investors are feeling optimistic and greedy, they buy it. But when they get scared, they sell it. And it often falls right alongside the stock market, so it's not always the safe haven some people claim it is.
Now for pillar 3, cash flow. We need to be crystal clear on our goal. And this analogy is perfect. Are you trying to flip a house for a big one-time profit, or are you trying to rent it out for a steady monthly check? See, flipping is a capital gain strategy. You buy something hoping the price skyrockets so you can sell. Renting is a cash flow strategy. The asset itself puts money in your pocket regularly. Most crypto is a pure capital gain play. You're betting on the price going up. There's nothing wrong with that, but you have to be honest with yourself that you're trying to increase your net worth, not generate income. Okay, we've analyzed crypto through those first three pillars. Now we arrive at the fourth. And honestly, when you're dealing with something this volatile, it is by far the most important one. This is the golden rule, risk management. And when it comes to managing risk, one concept is king, position sizing. This isn't just a friendly suggestion, it is the absolute key to survival in this game.
I absolutely love this analogy because it separates what you can control from what you can't. Think about it. A market crash. That's the Titanic hitting the iceberg. You can't control that. That's systemic risk. But you have 100% control over your personal risk. You decide if you get on the ship in the first place, and more importantly, you decide if you're bringing a lifeboat. Your lifeboat is your risk management plan. It's your position size and your exit strategy.
So what is this magic lifeboat? It's called position sizing. And it's simply the professional process of deciding how much of your money to put into any single investment. It's not a guess, it's not a gut feeling, it is a mathematical calculation based on your total account size and how much risk you're willing to take. This is the tool that prevents one bad trade from blowing up your entire portfolio. See, amateurs think about how much they can make. Professionals always think about how much they could lose first.
All right, let's make this super concrete with an example. Let's just imagine your entire investment portfolio is worth $100,000. That's the whole pot of money we're working with.
Now, a professional investor, especially when they're dabbling in something speculative, often has a very strict, hard and fast rule. They will not risk more than 1% of their total account on any single idea. 1%. That's a common, prudent standard that keeps them safe.
And here's the incredibly simple math that keeps you in the game for the long haul. You take your account size, that's $100,000, and you multiply it by your risk tolerance, that's 1%, and that equals your maximum risk per position, $1,000. This means that if you buy some crypto, the absolute most you should ever be willing to lose on that entire position is $1,000. This way, no single loss can ever cripple you. This is how you survive volatility.
So, we have our 4-pillar framework, and we have our golden rule of risk management. Now it's time to put all of these pieces together and actually design a personal investment blueprint. We're going to see exactly how a small, risky position like crypto can fit safely inside a larger, well-balanced portfolio. See, a really healthy portfolio isn't just one giant pile of stuff. It's structured with different goals in mind. You've got your core investments. This is the foundation, your long-term stuff, like solid dividend stocks. Then you have your cash flow strategies, things designed to generate consistent income. And then, at the very top, you have a small, separate bucket for what some people call mad money or speculation. This is where you put your high-risk, high-reward bets. So now we have to be brutally honest about where crypto fits into this structure. Based on everything we've talked about, its shaky fundamentals, its sentiment-driven market, its lack of cash flow, it belongs squarely in that speculative mad money portion of the portfolio. Calling it what it is, a speculation, not a core investment, is absolutely essential for managing your risk and your expectations. And this chart really brings the whole strategy to life. A sample blueprint might look something like this. Maybe 70% of your money is in those core long-term investments. Another 20% is working to generate cash flow, and that leaves just 10% for all of your speculative plays combined. Crypto doesn't get 10% all by itself. It has to fit inside that small, carefully controlled slice of the pie. And hey, don't just take my word for it. Look at how the big guys, the huge institutional investors, are approaching this. Even they are incredibly careful. A conservative institutional framework might only allocate 1 to 3% to crypto. So for a regular investor with a moderate risk tolerance, staying within that 1 to 5% range for your entire crypto allocation is a really smart and prudent place to be. It keeps the position small enough that even if it went to zero, it wouldn't derail your financial future. And this right here, this brings us to the ultimate takeaway. We have been asking the wrong question this whole time. The question isn't a simple should I or shouldn't I buy crypto. The real intelligent question an investor needs to ask is, based on my analysis and my personal risk tolerance, how does this specific asset fit into my overall financial blueprint? It completely changes the game from a gamble to a real strategic decision.
So, we end here. We've walked through that emotional dilemma. We've built a powerful 4-pillar framework.
we've applied it to crypto, and we've designed a blueprint for how you can allocate safely. You now have the tools and the process to stop relying on gut feelings and start making decisions based on solid criteria. The power is truly in your hands now. So the final question isn't for me, it's for you. What does your blueprint look like?